What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Ryan Pulis here with another episode of the CPA Zone. Today, we're going to talk about the multiple ways to make money with real estate. So, investing in real estate remains one of the best ways to build wealth for your average American. Now, I'm not a financial advisor. I'm not telling you what to do with your money or saying go out and sell off your investments and put it all into real estate. I'm not licensed to do that. That's not my intent. But it does help to know for anyone that's interested in investing in real estate, whether you're a current investor, exploring the option, or something you hope to get into in the future. It's good to know the various ways you make money in real estate. That way you can make the best decisions for yourself and your own investments. So let's get into it. The first way is cash flow. Now, in my opinion, this is by far the best and most important. Whenever you're analyzing a deal, your numbers should show a positive cash flow at the end of each month. Positive cash flow is just cash in minus cash out. If there's an amount left over, that means you have positive cash flow. Now, this should be the case after factoring in amounts for things like vacancies and capital reserves. Some of these expenses or costs that you need to factor in over the long run. So, you start renting a property, a tenant leaves, you need to replace them. You're probably going to have at least a month of vacancy in that particular unit. So you should factor that in. Over time, there's going to be large cash outlays for capital improvements. That should be factored in too. Most people, when they're analyzing a deal, they're going to factor this in by using some percentage of rents. And that's going to vary by the condition of the property, where you're located, how many units there are. So you'll have some percentage holdback for vacancies, some for capital reserves. You should still show a positive cash flow after making those adjustments. For each month, you'll have some holdback for both. You still want to see a positive cash flow. So your rental income should cover all costs, including your debt pay down, and leave a little extra for you at the end of the month. That excess is your positive cash flow, which can be used to build up your reserves, invest in new properties, and you sort of snowball that with your new purchases, and you continue to build up this positive cash flow and hopefully eventually get to a point where you're financially free, where your passive income can cover all your living expenses. An example of what positive cash flow looks like, so let's say you have a property, it rents for $1,000 a month. Your mortgage plus all operating costs, including your vacancy and capital reserve estimates, totals $750 a month. That's a positive cash flow of $250 every month. I realize some people invest for appreciation and they don't care about cash flow, but that's a bit more advanced, carries a lot more risk, and I definitely do not recommend it for beginners. You've really got to know your market to invest for appreciation only. My personal investment strategy requires a property to produce a positive cash flow. Now, a second way real estate makes you money is the loan paid out or debt paid out. Every time you receive a rent check from a tenant, a portion of that's going to be used to cover your mortgage. And a portion of each mortgage payment reduces the principal balance on that loan, which in turn increases your equity in the property. So your equity in the property is simply the value of the property minus any debt owed to others. So with each payment on that debt, an amount of the principal decreases, which means the amount you owe to others decreases, increasing your equity. Now, a third way real estate makes you money is through appreciation. Now, we just touched on this briefly, talking about cash flows. Some people invest for appreciation only. I like to look at it as a bonus. Historically, real estate's appreciated around 6% per year. Now, again, that's going to vary depending on location. The timing of when you buy plays a role in this, but over the long run, the value of real estate tends to increase. That appreciation also increases your equity. Remember, your equity equals the value of the property minus debt owed to others. So if you purchase a property for $100,000, you take out a mortgage of $75,000, and you cover the difference with a down payment of $25,000. Your starting equity is that down payment, $25,000. Now, let's say after year one, the property's appreciated by 6% and you've paid off $2,000 towards the principal on your loan. Now your equity is $33,000, an increase of $8,000. So we have $6,000 from the appreciation, $100,000 at 6% appreciation, increases by $6,000. You paid $2,000 towards the debt. So now rather than it being $75,000 owed to others, it's $73,000. So you have an overall increase of $8,000 of equity in that property. A fourth way real estate pays you or makes you money is through inflation protection. Rents tend to rise with inflation, as do many of your operating costs. But your mortgage is typically going to be fixed over a long period of time, typically 15 or 30 years for many residential rentals. On the commercial side, you're going to have something, it might be something like 25 years. There could be a balloon payment after year 5 or so that needs to be refinanced. For purposes of this episode, we're really thinking more in terms of the residential rentals that are more traditional loan types with 15 and 30 year fixed rate mortgage loans. So as your rental income increases, that mortgage payment is going to remain the same. It's fixed. Your other costs may increase with inflation as well, but that fixed mortgage means that's a cost that's not increasing. So you're going to increase your positive cash flow because your rent's going up by 1%, your operating costs will go up by the same percentage, let's say, typically, but your mortgage remains the same. So you have an increased positive cash flow, adding more to your bottom line every month. And finally, the fifth and our favorite way that real estate makes you money is through the tax benefits. Now, we've discussed many of the tax benefits on previous episodes. We'll talk about them on future episodes, but just to list a few, we've got depreciation. So you're able to take a non-cash deduction for a portion of the building cost every year to offset your income. Depreciation is typically what allows investors to show a tax loss, but also have a positive cash flow. Next, we have the real estate professional status. If you can qualify as a real estate professional, you can use your losses from your rental real estate to offset active business or W-2 income. To qualify, you need to spend more than 50% of your time in real property, trades, or businesses in which you materially participate. And you must spend more than 750 hours in real property, trades, or businesses in which you participate. And clearing both hurdles gets you out of that default passive status. So then, if you also materially participate in your rentals, then you can deduct those losses. We also have 1031 exchange. This allows you to exchange real estate for new real estate with no tax on the capital gains or depreciation recapture as long as you execute the 1031 properly. That's going to involve using a qualified intermediary, meeting the timing rules. It's the 45-day and 180-day timing rules. We also have short-term rental loophole, opportunity zones, cost segregation studies. The list of tax strategies available to real estate professionals is pretty long. We've covered a lot. We'll be covering more in future episodes. The main point right now is just to say this is yet another way that real estate makes you money is through the tax benefits. So to summarize, we've covered 5 ways real estate makes you money: cash flow, debt pay down, appreciation, inflation protection, and the tax benefits. That about does it for today. I hope you found value in this episode. If so, please leave a 5-star review or hit that like and subscribe button. Until next time, have a great day. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.